Welcome to the Victor H Investing live stream. It is June 26th. It is a Sunday, and we are on a weekend where it's going to be a 3-day weekend. On Monday, tomorrow, the stock market in the US will be closed to follow the Memorial Day holiday schedule, and the stock market will open on Tuesday. This past week was, in a summary, a flat week, but it had a lot of volatility. We had stocks really go up and we had stocks go down. I'm looking at the NASDAQ. So this is the last 5 days. You can see that stocks really had a ride. They really came down. They really went up, came down, went up. And the end of the week, just slightly higher on the NASDAQ. So it was an interesting week. Hey, good morning, Quags. How are you? Thanks for joining. So it was a flat week, and overall, I believe the stock market's expensive. I've been saying that for a little while, and that's okay. That means my stocks have been going up in value, but it makes finding stocks a little harder. Stocks that are discounted, stocks that are a good value. And what I wanted to focus on here in the live stream is kind of going through a stock screener and kind of going through a train of thought that I have to potentially find stocks that I want to add to my watch list and potentially buy to add to my portfolio for companies that I believe are discounted. So that's what I'm going to focus on early in the live stream. At any point, please ask questions, bring up stocks that you think are interesting to talk about and potentially you think are discounted right now that we can take a look at. So again, the market, I believe, is a little expensive. And how do we find, good stocks that maybe have been left out of this rally and are really good stocks to consider investing in? First, let's think about the economy just for a second. Now, I'm not the type of investor that looks at like a million data points and tries to get to a decision. I think that's just way too difficult. There are people that do that, taking nothing away from them. If it works for them, it works for them. I like to simplify things. I like to simplify and put a couple levers in a decision that are in my hands. From an economic perspective, I think the economy is doing okay. I don't think we're setting any records. But I like the live stream comments that I was getting yesterday when I did the interview with the Yield Nerd. And some of the comments made sense to me, which is we have an election year and I don't know who's going to win, but in an election year, the party who's in power tends to make it as easy for the economy to do well as possible. And that's common sense. It doesn't matter who would be in the office. They want to show that, hey, the economy is growing. There's jobs, gasoline prices are down. It's like they make the economy, every lever they have to make the economy work a little better, they're going to do it because they'd like, the citizens to be happier. Like, hey, the economy is working. So the incumbent is probably doing a good job, So I think that's going to be a tailwind. It's going to push the economy to a little more prosperity, I would think. So that's going on. Interest rates, I believe it topped out. Could they go up a little bit? Sure. Can they go down? Absolutely. Do I expect they're going to be lower in 2 years? Yes. And I think that's going to be a tailwind. So there's a couple of tailwinds there. What's the headwind for me? I continue to say some sectors are really expensive. Some industries are really expensive, and I'm careful in those industries. So I'm going to try to kind of share with you my train of thought. It's worked for me. And, my background, I'm 55. I have an undergraduate in accounting. I have a master's in business. But more importantly, I have worked professionally for over 30 years. And my job's taken me through a variety of industries. I haven't worked in every single industry. It'd be impossible. But I really like using my experience to my advantage. And as I go through this stock screener, I will spell out, kind of how I go through the process and things that I would encourage you to think about as you look for stocks that are going to work for your portfolio. Looks like I've got another comment. Empty design mill. Hey, thanks for tuning in. I think it's your first time commenting. Really appreciate you coming in and commenting. Please ask questions, bring up stocks that you think are interesting to talk about. Thanks so much for attending. All right. So the goal of this exercise is, hey, let's find some ideas on stocks that maybe we haven't looked at before and are worth considering. So let's talk about first stock screeners. What are they? Stock screeners exist in, I'm sure, your every brokerage account is going to have one. Every brokerage has one, I would think. I haven't seen every brokerage, but I could tell you that my brokerages have them. I don't like my brokerage's stock screener. I think it's a little elementary. I think it's a little bit too clunky. I like stock analysis. I like it because there's no advertising. It's very quick, fast. I can export data and so forth. I pay for a subscription. It's not a lot of money, and I think it's worth it to me. So sectors are, if you were to divide all the publicly traded companies around, on the stock market into 11 slices of a pizza, okay, you would get the pizza slices sliced out with these names. The pizza slices are not the same size. The market cap for technology, no big surprise, is humongous. $18.6 trillion. Communication services, 5.7, I think that's billion. No, that's $5.7 trillion. Utilities, industrials, healthcare, and so forth. And the way I've sorted this is I'm sorting based on the 1-year return. And the sector that's done the best, no big surprise, technology. Yeah, it's freaking awesome, especially semiconductor. But other software companies like Microsoft are also doing great. All right, that looks good. Communication services, where Alphabet, Meta, Netflix exist, that's doing fairly well. Utilities have done really well, and so forth. Now, that's for the 1 year. Now, when we get a little more specific and say, hey, how's it doing in 2024? Again, technology rises to the top, communication services, utilities, industrials, healthcare. So we could see that, hey, these sectors are behaving a particular way. Let's go one more level, go to the monthly. Again, thanks to our friends at NVIDIA, technology, utilities, comm services, healthcare. Hey, healthcare is showing up, materials, and so forth. So we can see how these sectors are operating and performing. We could also look at the history and see that, over the last 5 years, technology's done great. Consumer discretionary has done well. Healthcare has done well. Industrials. Comm services hasn't done as great as the others. And I think because comm services has some old companies, I'm going to call them legacy companies, that are pretty much on their way out. Old broadcasting business models are kind of broken. So I'm going to focus primarily on year to date and kind of focus on the sectors that look a little expensive versus sectors that maybe are discounted. We've talked quite a bit about like real estate as an example. Just viewers have brought up real estate companies, and when we look at them, they look really attractive. So I'm going to dig in to, I think, a couple of diamonds in the rough that are worth considering. Okay, so we have sectors. That's taking the whole economy, slicing it up into 11 pizza slices. And within each pizza slice, here's communication services. There's industries. So within this sector are all these industries. So now we're taking that particular slice of the economy and saying, okay, in that slice, there is internet content and information, Alphabet, Meta, entertainment, Netflix, advertising agencies, publishing. This is an old school business. Telecom services, AT&T, Verizon, electronic and gaming. And this one surprised me. This one is always I've always thought that this was a good performing sector or industry. It's actually down year to date. Oh, that's interesting. Broadcasting. This is an old school business going out of business. And then the other sectors like discretionary income have all these industries, consumer staples, all these industries, energy, financials, and so forth. A lot of industries to look at. So what I've done, I've taken all that data and I put it into a spreadsheet so I can slice and dice a little better. And you can see that all the sectors we just looked at are right here. I took the liberty of looking at the data based on PE ratio, profit margins, year to date. And this is more qualitative for me, is I kind of made a judgment call. What's my rank? What's Victor's rank? I think financials look really good because of the PE ratios that the companies have. The profit margins are good. Year to date's not kind of out of hand like technology. So I think financials look pretty good. Industrials look good to me. Again, we're going to have some tailwinds with, the existing party really trying to pump up the economy. So I think industrials are going to do well this year, probably going into next year, especially as interest rates fall. So I like industrials. I like energy. I think energy's kind of not risen to the value that they have. Oil prices are near $80 a barrel. I think that's a good price for a barrel of oil. But other commodities within that space are also going to be in demand. Materials look good, consumer staples and so forth. The worst industries or sectors, I should say, is I've never invested in utilities, and it's just me. I just don't like them. Look at the 5-year return, 19%. And they've done that whole return in 1 year. So this has just been historically a terrible sector, and I just don't touch it. Healthcare. You know what? Healthcare, I've been waiting for it to operate better, and it hasn't. So I think part of it is the PE ratios are too high, profit margins are too low, and I think that really moved me on this exercise to really bring down healthcare. I don't expect much out of it, although I was quite bullish on it just not too long ago. Technology, I would rank 9th, not because it's a bad sector, but because it's so darn expensive. It's hard to find value there right now. And then communication services, ditto. Meta's doing great, but man, I'm not buying any more Meta because I've got plenty. It's my biggest stock holding in my portfolio. And then real estate, it looks interesting. Consumer discretionary looks interesting. All right, so that's very high level. Now let me pause there and take a couple questions here. So Quags, mine looking at FCX. So I absolutely can look at FCX. Just give me a few minutes and we'll get there. And then we've got NK. JJ looks as distressed, talk, etc. Can go behind them. The recover. Thanks. Yeah, let's take a look at J&J. So J&J has been historically a very respected company, but they've had problems. Now, when a company has problems, some of the time they fix them and they're back to their glory days. Like General Electric is a good example with J&J. They didn't fix the problems, and that company took investors, including me, down pretty hard. So we'll look at J&J and we'll see what we're looking at. Okay. So give me a few minutes. Let me finish my train of thought with the analysis that I prepared. All right. So we've got all these sectors. Now, all the industries that were listed in each subcategory, I put into one spreadsheet. It's a long list. Now, again, I'm not going to analyze every single one. Let me use kind of tools to kind of figure out what's worth looking into. So if we look at year-to-date performance from largest to smallest, we're going to get utilities have done really well. For some reason, utilities became really valuable. I think everybody believes we're going to run out of power with all these data centers consuming power. I don't know if that's going to happen, but we'll see. And then we have electric vehicles consuming power. So there is some logic there, but for the stocks to go up 115%, I don't know. I think that's a little suspect. That's a little bit of a bubble. Technology, obviously, technology. Yeah. These are semiconductor companies, hardware companies have really been doing great year to date. Electrical equipment parts, so they could feed the power companies as well as data centers. That makes sense. Shipping, right? Like Zim, we cover Zim, and shipping has been doing well. It was left for dead like a year ago, where like, oh man, shipping rates are going to be terrible forever, but they've really responded. So utilities, renewable, copper, material companies, copper has been doing well. So that's kind of like, maybe the top 8 companies, and you could see that you could really analyze this. And I'll put this spreadsheet on my channel community page, and I'll share this with you guys so you guys can download it after the live stream. All right, so we got a sense of all these, but let's look at the bottom. Let's look at the kind of like the companies that are really lagging. So now we're looking at which ones are really lagging, but potentially these are good industries that, hey, I wouldn't mind buying a company that's way discounted, that maybe is discounted today, but in a year is going to be worth a lot more. And the first category is healthcare retailers. Now, this would make sense because I know Rite Aid is in bankruptcy, Walgreens is being operated terribly, but let's take a look at that because that's the worst performing industry. We're looking at industries right now. And I wouldn't mind looking in there, and I'm going to look in there to see if we can find a diamond in the rough. Communication services, broadcasting, I can understand why it's down a lot, and I'm not going to buy a broadcasting company. No, thank you. And then another topic or point that I'll make is there's so many industries. There's no way I could kind of understand every industry. If I don't understand it, I don't invest. I only look at industries that I can understand. Pharmaceutical. I worked at a pharmaceutical device company. I help in the manufacturing process, distribution, and sale of pharmaceuticals. I understand the FDA from the participating in taking a drug into market through that process. So I have a sense of, okay, what's that industry like? So I don't invest in every industry, just industries that I understand. And I encourage you to follow that type of guideline, which is don't invest in something you don't understand. Understand it enough to make a good decision. You don't have to be an expert in it, but you have to know enough to make a very good decision on it from an investment perspective. Then we go down further. Year-to-date real estate. This one caught my attention. Real estate industrial. In this category, it's warehousing, it's storage. I'm like, I don't know why that's discounted so much. I'd like to look at that closer. Real estate diversified. Understood. I think we've gone over real estate a couple of times in our live streams, and it's because it's so beaten up and it's discounted. So, let's take a look at real estate. And I'm putting a yes on my interest here, and then I'm going to sort these. But I wanted to kind of go through and show you how I'm looking at industries. So I keep going down the list. The next one is resorts and casinos. Now, travel is doing great. I own Airbnb and United Airlines. Their volumes are off the charts. So why would casinos be discounted so much? I want to look at that because there might be some value there. Auto manufacturers. Now, Tesla's, tanking, right? It's crashing. So maybe that's part of it. But let's take a look and see if there's more value left in other companies. I'm not a Tesla investor. I have a video on my channel around Tesla, and we'll get into that industry. Other companies like in the materials sector within the industries classified other industrial metals and mining, that's been kind of beaten up. So I'm going to look at that. And then next one is beverages, wines, and distilleries and consumer staples. So I'm going to look at that and kind of drill into it a little bit. Next one is gaming. And I'm just a fan of video games, and I just don't understand why they're so discounted right now. So I'm going to take a look at it. And then last one is industrial conglomerates. So I'm going to look at that. Let me catch up on a question here. Empty by design. I think the stream is 720, the resolution. Oh, geez. Sorry, guys. Thanks for bringing that up. Let's see here. Sorry about that, guys. I should have done this to begin with. And from this point forward, you should be able to see it a lot better. I apologize for not bringing it into bigger screen space. Thank you for letting me know. Apologize. All right. So I'm going to look at the companies that I've got listed as, because I did this, before we started the live stream. And I said, hey, these are worth taking a look at. Companies that, pharma, REITs, casinos, auto, material companies that are industrial metals and mining, beverages that include wineries and distilleries, gaming and media, multimedia, and then conglomerates. And again, when you go through this list, you might say, hey, I really know the steel industry, so I want to look at steel because it's kind of beaten up. You pick the industries that you think you have an information advantage, that you really understand that industry. You understand when is a good time to buy into those stocks, when they're really discounted, but later on, that economy within that industry is going to really click, and then the stock's going to shoot up. So we're going to take a look at those a little closer. I'm going to keep this list off on another screen, and then we'll just take one at a time. So let's start with our friends in healthcare. So within healthcare, I wanted to look at the pharmaceutical retailers. So pharmaceutical retail. All right, so within pharma retail, what are the participants here? Walgreens, okay? We know what Walgreens is all about. They've really been tanking, so understood. And then we have high tech, but one company that showed up was this company, Pets, right? Which does pharmaceuticals for pets. And this company, if you look at it, it hasn't been doing great. It's been kind of tanking, $4 per share. It's a tiny market cap. And I've been a little concerned about, small caps. So this is a $276 million company, and their market cap is $87 million. Wow. So you're getting it for a fraction what their revenue is. They did lose money, but let's see other things. Their dividend is super sky high. Price target by analysts, I don't know how many analysts cover it. It's really high. And you see that their sales have been coming down, but sales had been going up for years. And then something happened. After 2020 was a very good year, I imagine, because with COVID, people wanted to get their pet stuff online, understood. And now with after COVID, it looks like their sales went down. Okay, let's look at the quarterly. And their sales did go up in the most recent quarter. That's a good sign. If they keep going up, I mean, this company maybe is really undervalued. So that's on the sales side. Revenue, we got to make sure, I want to make sure that the company is healthy. It's growing its revenues. It's got products customers want. Now, the profitability, it's not a complete showstopper if they're producing free cash flow. When we look at free cash, they have, I'm still in the quarterly, so let me change it over to annual. So in the last full year, 27 million cash from operations, 5 in capex, so about 20 million in free cash. And previous years looked like they're free cash flow producing company. That's a very good sign. If their balance sheet is healthy, they have 104 million in cash, and their debt, long-term debt, 0, current debt, 0. Very hard to go out of business when you don't have any debt and you're producing free cash. So this one here looks interesting. What is going on here? Like Pet Med Express. I'm going to do more due diligence, but there's an example of, while the stock market is doing this, right? It's going up on the NASDAQ. It's up 61.67%. You have companies that are doing this. And when you look at their business, now pets, I think people love their pets. They treat their pets like family. They take care of them. They buy their medicines when the pets need them. So I get the business. And now, is this company good enough, healthy enough for me to invest? Maybe. This is a maybe, but I just wanted to show you a diamond in the rough. And it's a tiny cap company. They can double like in a month, but they could also go out of business. Now, they have enough cash that I'm thinking these guys are not going to go out of business. It's hard to go out of business when you have a good balance sheet and you keep producing free cash flow. You may not be relevant. Customers may not grow like the number of products they buy from you and so forth. But maybe this is worth, putting a couple bucks into it and just letting it ride. So there's an example of finding something within the first industry we looked at. So let's look at another industry. All right, so the next industry I'm going to look at is real estate. We're going to look at real estate industrial, and I see comments coming in. Hang in there, guys. I'll be right with you. 1 second. So we're going to go to real estate, and we're going to look at, and I sorted real estate as well by, best to worst. And you can see real estate is just kind of being left or dead a little bit because of higher interest rates. Now, I like markets where there's a lot of fear, because fear tends to have people sell off companies that are really good value. So I'm okay with, entering a space like this. And I do understand certain parts of real estate, not every form of real estate, but I like real estate. All right. So we're going to look at industrial, and industrial is made up of companies that run a lot of warehouse space, logistics centers, and the biggest one being Prologis. And these guys probably do LPL, which is outsourcing of your warehouse. You send your product there, you own it, but they're going to pick, pack, and ship for you. They're going to distribute for you and so forth. There's also public storage. You probably have run into public storage. I'm tracking public storage, so I'm going to take a look at public storage. And other companies, you can see that year to date, these companies have been sold off. The PE on public storage looks pretty decent. When I look at public storage, the stock has been up and down, up and down. It's recently, had a pretty nice low there. It's trying to do the same thing again, coming down. I have a buy on this when it reaches 260. And, this is kind of a little diamond in the rough. This is a larger cap company within this space, $47 billion. Their revenue is $4.5 billion. And their dividend, look at that, 4.4%. Beauty, because it's a REIT. REITs pay higher dividends. But when you look at these guys, they're growing. They're growing their business. So that's looking good. When we look at cash flows, they produce plenty of cash. They have a solid balance sheet. I just thought that they were a little overpriced, especially since they reached a peak with COVID. A lot, there was a housing shortage. There was a lot of things going on that created demand for storage. But now, as we look at the 1 year, there's opportunity there. So public storage is going to be on my watch list. Potentially, hey, this is a brand that I know. This is a company that I wouldn't mind owning this and putting it in my portfolio. Right now, the REITs that I own MPW, which is a high-risk REIT in the healthcare space, and CTRE, which is also in more of the elderly care / healthcare space, and they've been doing phenomenal. I love that REIT. Wouldn't mind owning another REIT, especially one that looks high quality, that's being discounted year to date, and really, has this volatility. Volatility is my friend. Volatility brings down prices. I can buy them and then watch my stock price go up. All right, so let's talk. Let me catch up on comments here. So Quags, thanks again for your comments. If you're looking at gaming, start with Activision. So I can't look at Activision because they were acquired by Microsoft. And I know that because I used to own Activision. Thank you, Microsoft, for paying me a nice premium when you acquired Activision. I appreciate it very much. And now they're a part of Microsoft. So thanks for the comment there. Quags, if you're looking at steel, take a look at MTUS. Let's do it. MTUS. So thank you for that. And then next comment, check out RCL and then HTL, which I think is Hilton. I'm not sure what RCL is, but I think Hilton. Yeah, and recently I watched Scott's Due Diligence. He did a nice video on Hilton. Very good video. Encourage you to take a look at that if you're interested in Hilton. I saw your review of Himax earlier today. Does it make sense a company size pay a dividend? Okay, so I'll take this question on. So Himax produces a lot of cash, and part of their, the semiconductor space traditionally has paid a dividend. So they're just keeping with the expectation in semiconductor that they pay that dividend. It is a very good cash producing company, and they have a very ambitious, prosperous guidance. They're expecting to do really well because the markets they serve are really coming back. So having said that, I'm fine with them paying a dividend. They are not under any stress. Their balance sheet's very good. So there's an answer to your question. Thanks for the question. Thanks for watching the video. I really appreciate it. I think Hymax is a neat little semiconductor company. I've owned it for a long time. What would you buy pets at? It's not listed on Fidelity. Oh, weird. Okay. I'll come back to pets. Give me a second. Let's see. Pets. So these guys trade on the NASDAQ. So I know Fidelity does have some rules, but they should have it this listed. I'm going to look at that as a homework item. Fidelity, if it's like under a certain dollar amount and it might be a market cap, they will not list it on their brokerage. You'll have to find a brokerage that will sell it to you. I'm pretty sure like Robinhood or somebody else would sell it to you. Good question. Thanks for pointing that out. I didn't look that far. So thanks for pointing that out. I own a little bit of Stag. Stag. Take a look at Stag really quick. And then, man, the comments are coming in fast and furious. All right, let me take a break from the comments, and then I'll come back to the comments. Thanks so much. Keep them coming. I just want to keep my flow with the sector and industry review. So we left off on looking at REITs. Next, let's look at casinos. This one looked really interesting to me. Casinos exist in the consumer discretionary sector. And let's see if I can. So when we go to consumer discretionary, it is really a long list of companies. You can see it might be the longest list, right? Consumer discretionary. So you got things all over the place. We're going to look at this one, but again, if you have information advantage, hey, I worked in a home improvement capacity or leisure, that's where you have an information advantage. I travel to casinos. I understand casinos, and that's the extent of my advantage. But what I like is buying something that's discounted. When we look at this list, you see a lot of red. But when you look at like travel is doing really well. Just look at United Airlines or Delta. They'll show you that people are buying tickets to travel. Las Vegas, the economy is doing really well. Other places, people want to get out and have fun. So Las Vegas Sands is here. And one company that I've looked at in the past is Boyd Gaming. Boyd Gaming, you look at some of these metrics, and I actually owned this stock for a little bit and then sold off. It's a small cap company, less than $5 billion. Their forward PE is 9.2. They pay a little dividend, not breaking any records. Analysts say, hey, it's 80% discounted. So, wow, man, that's pretty good. And we'll see how many analysts cover it. But if you look at the stock, it's had some periods of rallying, and it's just really come down. When we look at the financials, the company is growing. It's not having boom periods, but it looks pretty decent. We look at cash flow. Cash flow looks really good. Free cash flow, $540 million of free cash flow. So that's pretty darn good. And in previous years, because I think they had like a post-COVID boom, did even better. So we have a less than $5 billion company giving you more than 10% yield of free cash flow on their market cap. That's really good. So this is an example of stuff that's being left behind. And it doesn't make sense to me high level that casinos are being discounted so much. It's not that they're broken. It's not that the economy is lagging. If anything, I can point to factors that say there's probably more people at a Boyd Gaming casino spending more money at their resorts, gambling more on their tables. So there's another idea in BYD. Let's take a look at automotive real quick. The next one on the list is automotive. And that is on consumer discretionary. Now, in automotive, our friends at Tesla, biggest market cap in the space, not doing so well this year, not doing well, in the 1 year. Toyota is doing great. We looked at that in another live stream. Ferrari, this is more of a brand or a licensing company, like the Ferrari brand. It gets put on so many shirts, hats, and so forth that they make a lot of money there. But Stellantis, this is a big company, global company. I own Ford, but this is an industry that most people can get their heads around because, frankly, we've driven cars. We kind of grew up with understanding cars. And this is a space that really hasn't been doing great year to date. And there's companies that are high growth companies like Rivian, which I've looked at. I'm not a buyer in Rivian. I don't think it fits my investing model. But there's companies that are growing and there's companies that are very traditional companies. All right. So next one is materials. We're going to go into materials, which we're going to look at other industrial metals, and mining is the industry within materials. So let's get to the sector of materials. And here it is. And there's a reason why I looked into this, because I've been an investor in this particular industry and I've done really well. I actually owned BHP. I liked owning it and really was satisfied with it. Right now I own TX, which is similar to BHP, but a little different. They actually make an end product. But BHP is down in Australia primarily, and their big commodity is copper. If copper prices are up, this stock just takes off. It pays a good dividend. They announce their earnings twice a year, by the way, in case you're looking for the quarterly. And these guys, if the Chinese economy does well, these guys do great because they sell a lot of their materials to the Chinese market. They sell their steel ore, iron ore to make steel, and copper and all the other things they produce. So this company is interesting, and I've invested in it, but just another diamond in the rough that this is another industry and space that has been discounted. All right, so I'm going to jump down to gaming just so we can cover EA Sports, and then we'll wrap it up on industries and get to some of these stocks that people wanted to look at. So gaming is going to be in communications, communication services, gaming, and media. And again, like this space is, I think, being reinvented, right? Because you have companies like Roblox that, you don't buy it in the stores. GameStop, right? That's kind of in this, except they're a retailer. But all these gaming companies are troubled. This one's a Chinese company, NetEase. I'm going to look at Electronic Arts. Now, these fundamentals did not knock my socks off. They looked okay. The company is had an up and down, 1 year chart. It's kind of been up. So I think if this continues to be volatile, especially if we have a pullback, this might be worth taking a look at. And I'm not overly excited about EA Arts, Electronic Arts. And the reason for it is I'm not sure if EA is got more of their business in the past. Like, hey, they're going to be left behind because everybody's going to stream. Everybody's going to be buying games that are really more in a SaaS model as opposed to the traditional models. I don't know that enough about EA Sports. I put them in the category with Activision as kind of like being that traditional gaming company. And the new type of gaming company is like a Roblox, or even Facebook is putting together, games on their Facebook platform. You have YouTube putting out games. You have Netflix putting out games. So that's the new competition for this space, is all these streamers are saying, hey, we can start growing in games because we already have the audience. Why don't we start putting games out there too? Which is why I continue to think Roblox is going to be acquired. I think Roblox would be a natural acquisition for like a Netflix, who could just quickly, with $20 billion, acquire a company that produces free cash flow and has a huge customer base. So that is the last industry. But to put a wrapper on why I'm kind of taking this flow is, every market, whether I think it's expensive or it's really discounted, it offers up really good value. We just got to find it, and really kind of going through and rationally looking at things that I can understand, and then I could dig deeper into and potentially find another company that is discounted at the current time. That's what I was hoping to show through this flow of looking at a stock screener, starting with sectors, and then going into industries, and within those industries, looking at the companies and trying to draw out a few companies to really investigate. All right, good stuff. So let's move on. Cinematographers, thanks for tuning in. Victor, the high mix suggestion is also a perfect breakout trade setup. More of these, please. You got it. You got it. Yeah, I like little companies. I'm a fan of smaller companies, and I've made some money there. You know, I hope the high mix really does take off, because I'm hoping that all small and mid cap stocks really start performing better. Because the last year and a half, it's been a big cap show. The big caps have kind of dominated, which is just reality, right? So it's good that I had a couple big caps, but I think small and mid cap stocks at some point will start to rally, and at some point will outperform big caps, just because big caps are so expensive. You look at a Microsoft, right? It's a $3 trillion market cap. If they doubled, it'd be $6 trillion. How is that possible? The big companies represent like mid 30% of the S&P 500. If you look at the top 5 or 7, that's a huge, huge market space. So, all right. So Neil likes MPW. I do as well. I think MPW is setting up well. I think the bad news is kind of being put to rest. I think they're beginning to see the road ahead, the light at the end of the tunnel. And as good news flows into the company and they get past the bad tenant, this stock can really come back to where it was, or close to where it was. If it does, I tripled my money. So let's see how it goes. All right. So Tacha, I don't know if you've commented before. Thanks for tuning in. Can you elaborate on why financial sector is interesting in your opinion? Yes, I can. So let's look at the financial sector. All right. So to begin with, financials in 2023 had a really discounted, model, because we had a lot of fear due to the regional bank failure of Silicon Valley Bank. So that really discounted banks, and it kind of just put a negative sentiment in financials. Other factors that came into the picture was insurance companies had a kind of a big causal factor adjustment, which is car prices really went up, home prices have been going up higher, and insurance companies can't, adjust their prices like overnight. They have to work with regulatory authorities and then show that, hey, the cost of these things has gone up. We need to increase our rates and get their consensus before they can do so. Frankly, if the regulatory agencies don't do it, then the insurance companies move on. They don't insure that state. And so the insurance companies tend to have a good partnership with these governments. That's taken place. That's behind them. So there's a lot of big factors that have really fueled a current rally in financials. So I think that certain industries within financials are attractive. Where I'm investing my money is insurance. Insurance companies like Allstate and Prudential have been doing great, and they're doing really good right now. And I think they have more room to go. I'm investing in Citibank. I think that the banks are doing great, and I think the interest rates have really caused people to put more into their savings. And I think that Citibank and JP Morgan and the bigger banks are going to do great. Regional banks are going to do well also. I just really concentrated my investment into Citibank. Other things in capital markets, my Robinhood stock has doubled in the last 12 months, and I think it could continue to go up. My Coinbase stock has gone up really well, I think up to 150% or so. So there's just a lot there in financials. Financials has not been going parabolic like the semiconductor industry. It's just had really healthy growth after a very bad year, or a couple bad years, I should say. So that's why I think financials is interesting to me, and that's why I'm putting my capital to work within financials. Thanks for the question. It's a very good one. Thank you. So we got a good comment, Quags. Never mind on pets. My app was glitching. Oh, okay, good. So you can find it. All right. All right. Hey, cinematographers. Yeah, my channel is growing. I think it's growing in the right ways, which is I love interacting like with other investors. I think you're seeing that in my interviews of other investors, like the yield nerd yesterday, Scott's due diligence a week ago, and I'm going to keep doing that. And the reason for it, my intent, my mission statement is to make as much money as I can from my investments. It is a lot of fun, very gratifying. And how do I get better is because I watch a lot of YouTube. I do a lot of reading. I do a lot of analysis on my stocks. But B, when I have to represent my information, my proposition, my hypothesis, it makes me study it that much further. And I'm glad that you guys are seeing value out of it, because I'm going to keep doing it because it makes me a better investor. And I'm hoping you guys see, some interesting value out of it and you become a better investor. So that's the intent of my channel. I'm glad that you find it useful or interesting, and I'm glad it's growing, and we'll see where it goes. Really, my oil stock is 85% discounted. So which oil stock is that? Only 17 cents. Neil, what ticker are we talking about? You talked about MPW. Yeah, give me that stock symbol, Neil, and then we'll talk about it. All right, so Neil doesn't like insurance, never insurance. Okay. Yeah, and there's some industries, whether like something I said earlier, which is if you don't understand an industry, I encourage you not, don't go too far. I don't understand it, I don't invest. There's some industries that I do understand, like utilities, I won't touch them. And if somebody understands insurance and they don't want to touch it, totally understand. You should follow your instinct. You should follow your analysis. So totally respect it. And then what's your opinion of Leggett and Platt? And they are kind of a services company. We'll take a look at those. I got a list of stocks that we're going to run through once I get caught up here, and hang in there with me. All right. So I am caught up on comments. So let's rock and roll on some of these companies that people want to look at, starting with FCX. Let me close some of these windows so I don't drive myself crazy. So FCX. Okay. So Freeport, I think, Freeport engages in mining mineral properties in North America, South America, Indonesia, primarily explores for copper, gold. Okay. This is a materials company, and this is a $74 billion company, $23.7 billion in revenue. Their forward P is 29. Dividend is 1.16. We look at the 1 year, nice, 54% higher. Very good. So you can see the return here. These guys are clicking. And look at their revenue. It's been fairly flat. So there is an expectation, I imagine, that this company is going to do well. And that's why investors are flocking to it. They probably have a solid balance sheet, almost $6 billion in cash. Debt, current debt, $766 million. Long-term debt, see, very low debt. They have almost as much cash as they do debt. Very good balance sheet. And they probably produce a ton of cash. And free cash flow, not so hot this past year. It looks like they had kind of a rough year, and they're probably going back to the glory days. We look at analysts, 12 analysts are looking at the stock. They say it's overpriced by 4%. So the stock price has been going up. I can understand that sentiment. And their earnings per share is supposed to really rise. So I think that's what investors are looking at is, hey, this company is going to do really well. Now, this one here is the time to buy. If you can get the time machine was in March, because it's really tough for me to buy stocks like these. I like buying when they're discounted. My position in this space is with Ternium, and Ternium's been doing well for the year. It's 12% year to date, just 2%. I bought more shares on these bottoms here. They pay a really high dividend and they do pay it. So I like this position here. And I've been an investor for some time in this company. See this volatility? Volatility is my friend. If I can have some volatility like this, I could buy at really discounted prices. And I have about a 40. Let me take a look at my investment in TX. So materials, Ternium. So I've invested 41,000 and I've got my investment is at 51,000. Make this a little bit bigger. So I've done well with Ternium and it pays that nice dividend. So overall, hey, like parking money where it's going to pay me a nice income and over time it appreciates. So that's that space. Again, we're not talking about technology, which is taking a lot of the airspace out there. We're talking about other industries. All right, let's talk about J&J. That was another stock that came up. J&J, for a long time, it was kind of like considered one of the best in its space. It's in the healthcare space, and it was deserved. It's still a major cap, $353 billion, revenue of $81 billion. And their dividend is 3.38%. Forward PE is 13.6%. Now their stock, you see this volatility. And judging from the problems they've had, I think their stock fared okay. They had big problems. They had all these like big lawsuits where millions of people were affected by their products, like the talc problem. They've had other problems. That could have really brought them down, but their stock kind of held up quite well. Their revenue has been increasing, which looks good. Balance sheet, I can tell you, is probably going to look good because they have a very good credit rating. I own some of their bonds, by the way. I don't own their stock. $23 billion in cash, and long-term debt is less than that, close to $26 billion. Actually, 29 billion. So they got pretty good load of cash and they produce good cash flow because this is a healthcare company. Healthcare companies produce great cash. So $18.2 billion of free cash. Beautiful. Now, if I were to run a model on J&J, I'd probably show that this company is fairly priced, maybe priced a little bit at a premium. They have a 13% discount based on 14 analysts analyzing the company. And they really value the company based on earnings per share. Earnings per share did fall, but it's supposed to rise modestly over the next couple of years. The position that I have in this space and that I'm buying more into is Pfizer. I think Pfizer provides a really strong proposition, not too far away from the revenue that J&J just showed, but their market cap is less than half of J&J. Their forward PE is 11. Their dividend, which they can afford, is close to 6%. This stock has been left for dead. And this is Pfizer. They own these really important drugs that are not going to go away. Here's another thing that I love about Pfizer is you look at their revenue for 2023, $58 billion. And I like looking at the number before COVID, which is kind of like, well, this is the company before COVID, and they had all these COVID vaccines. They were a $40 billion company. Now they're a $58 billion company. So obviously they grew organically outside of COVID vaccines. They're a bigger company. They produce awesome cash flow. And when we look at their stock price, the 5-year chart, again, I just showed you 2019. The stock price was up here at, let's call it $35 to $40 a share. Now the company's a $58 billion company, profitable, generating free cash flow, and it's less expensive than it was 4 or 5 years ago. So I love Pfizer. I'm buying into it and we'll continue to buy into it. Year to date, it's doing, I guess, zero, but last month it's done okay. It had a good earnings call and it's been doing quite well. It's up 10% in the last month. MTUS is the next symbol that came up. Metallus. I like the name. Maybe because I listened to too much Metallica growing up. Metallus manufactures and sells alloy steel, carbon, and microalloy steel products in the United States and internationally. The company offers special bar quality, Okay, so they produce a, I'm going to call it a material, a finished material that would go into production or construction. It's a $1 billion market cap, and you're paying less than revenue for the company. Interesting. No dividend. Forward PE is 12. Okay. And if we look at the company, it's been kind of up and down, I imagine, because of steel prices. Okay. But it's been going up recently. Looking at the quarterly, it did go down a little bit compared to the previous year quarter. Cash flow wise, produces good free cash flow. Always, for the last 5 years, has produced positive free cash flow. At this rate, we're at $75 million. So 75 million. Yeah, this thing would probably show a discount. And we just looked at, let me draw kind of like an observation here. So we just looked at this company. This company produces mining, and this is not the same company. These guys do different materials. If you believe the economy is going to support the end markets that Metallus is going to serve, you're getting this company at a discount. If there's going to be a recession in this industry, you're going to be waiting a while for your stock to perform. Year to date, not bad, 2%, 1 month up. So investors are paying attention to this stock. And the stock looks interesting for a small cap. Short sellers are not attacking it. Interesting stock. It's a tiny company, but I think it looks interesting. I'm going to give that one a circle. RCL. Royal Caribbean. Oh, man. Look at this. Look at it. I knew this was going to be the case. COVID happens. These guys are left for dead, and I can't blame people for expecting that. Nobody can go on cruise ships. But then just as recent as 2022, you could have bought it $32 a share and quadrupled your money. Yay. That would have been a fun ride. Now, I did not have the courage to buy into Royal Caribbean or other stocks like that. 1 year, 89%, year to date, 16%. So obviously the company's clicking, and people love cruises. I've never been on one, but I do have a bucket list item to go up to Alaska on a cruise ship. So I totally get it. But I have friends that love cruising. They just love this experience. Market cap is 38 billion, 14.7 billion in revenue. So you're paying 2.5 times revenue. Forward PE looks pretty good. They don't pay a dividend, surprised. And then financials. So this is where, look at this COVID drop. They went from 11 billion to 2 billion. Hoo-hoo, man. And then 1.5 billion. Oh, how did they even survive? And now they're back. And when you compare 2023 versus 2019, which is a unaffected number before COVID, you got the company was at 10.9 billion in revenue. Now they're much bigger by 3 billion. Very good job, Royal Caribbean. They're making money. Excellent. And cash flow wise, free cash flow is not setting any records, and they had very negative cash. I would be looking at their balance sheet because their balance sheet may be in a lot of trouble. Cash is 500 million. We've got current debt 1.7 billion, and then 22 billion in debt there. Their debt to EBITDA, that's really important in this company. 4.19, that would disqualify it because I need it to be less than 3. And that balance sheet is risky. If we have another big thing happen in the world where cruise lines can't operate again, or maybe are affected, maybe they do go bankrupt this time. But interesting chart to look at and see how well the stock's done. It's not an investment for me due to the balance sheet and due to the fact that they don't produce a lot of free cash. Thanks for the question. Interesting stock. HLT, I think that's Hilton. And so Scott's Due Diligence did a video on Hilton. excellent video. It showed that the stock is really sold at a premium, primarily because look at this stock. It's just been rocking and rolling. Nice upward trajectory. Upward trajectory, 47%. Year to date, I think investors are beginning to get fatigued on this stock, but it's still up 12%. This stock, I think if you look at the cash flows, they can't substantiate this market cap. And again, I just saw the Hilton video from Scott like 2-3 days ago. It's fresh on my mind. And he's been kind of going through a string of hotel stocks. He did Marriott, I think, yesterday, and he's doing a really nice job on those. I own Airbnb, and I think high level Airbnb is growing much faster and continues to be discounted, in my opinion. And the reason for it is when you look at Airbnb, it's been doing really well. Like for 1 year, 36%, year to date, only 7%, because you see that it peaked and then it came down. The company announced earnings. The earnings were really good, but their guidance was that the second quarter wasn't going to be as great as they would like it, but the third quarter would be great. So it's a pretty good time to look at Airbnb because the stock's been beaten up a little bit. And if you look at their growth, look at this growth, really nice growth. Quarterly, they keep their growth going. And this company produces cash flow that we would dream of. Almost $2 billion in the last full year. And that's a quarterly. Sorry. Showing the wrong number. Cash flow for the last full year is $3.9 billion of free cash flow from a new young company that's growing, that's disrupting the way that people vacation and stay at a property. You know, I love the Airbnb experience. I could tell you about my trip to Europe that I did last summer to Italy. I could tell you my times in Mexico, down to Mexico City, all over the United States. It's a really fun experience. So a lot of people like it too, and they're growing organically around the world. So my play in that space is Airbnb versus Hilton. Again, watch Scott's due diligence to watch a very good video on Hilton. Next one is Stag. So Stag Industrial, it kind of rings a bell, but I can't remember what they do. It's a focused REIT, ownership of industrial properties in the United States. Okay. So their sectors, I'm trying to figure out what industries they support. I'm not quite getting it out of here. But it's a REIT, and they pay a 4.2% dividend. Over the last year, the stock's up 3%. Year to date, it's down 10%. You're looking at a net income producing company that's fairly, priced, I think, at a low level. Analysts think it's 11% discounted. This looks interesting. It's not a giant REIT, so looks like an interesting stock to take a look at. All right, so Liggett and Platt. So Liggett, spelling it wrong. Here we go. Yeah, I was spelling it wrong. So Liggett and Platt designs, manufactures, sells engineered components, products in the United States. So they are a consumer discretionary. I don't agree with that. It's more like an industrial. Yeah. So they produce product that ends up in other products to the consumer. So small cap company, 1.4 billion, revenue is 4.6 billion. So you're buying it for a fraction of the revenue. Forward PE is 8.8. Look at this dividend, 13%. Beautiful. Analysts think it's 25% discounted. When we look at the financials, the stock is probably getting hammered because its revenue growth is going down. Interesting. They've been around this number for a while. Interesting. So they had a really down COVID year, understandably, and then they got back to growing. Maybe they oversold, and then they're like, okay, people don't want to buy the product because they have too much inventory. Quarterly, yeah, the quarterly number really bothers me. They've lost almost 10% of their revenue. If you compare the quarter that ended March 31st versus the same quarter in 23. And that's a down quarter. So the revenue is not headed in the right direction. It's headed in the wrong direction. I like seeing revenue that grows, or there has to be a reason why it's not growing or it came down. I'm not seeing the explanation as to why. I would really want to know that before I could, even entertain investing in the company. I have to buy into the company first. I'd want to know what their products are about. Do I think that that's a good market? They've been around forever, 140 years or so. So I'd want to kind of get my head around that. For financials, so we did that. We looked at the forecast. Only 3 analysts cover it. They say it's 25% discounted. And their forecast is that their earnings per share is really going to go up next year. This year, it's going to be profitable, which is moving the right direction. And then it's going to grow nicely. So there'd be some homework on this one just to make sure, why was revenue going down the most recent quarter? Why is revenue going down? That might be an explanation as to why this stock is being punished. But these kinds of stocks, if you're one of the first investors to realize they're turning the corner and they're going to start heading up, it's an opportunity. If you have an understanding advantage and an information advantage, this could be a good opportunity. But be very careful in making sure all your questions are answered before you move on a stock like this. So we got through the list. I'm going to do one more because somebody asked about Bill on the comments on a video. Here it is. So Bill, this is a software company. It's a little software company that focuses on small and mid-sized businesses to do part of the back office automation. And they do primarily the accounts payable and accounts receivable for a company. I get that. It's a $5.5 billion company. Revenue is $1.24 billion. So you're paying about 4.5 times revenue for the company. Their forward PE is 23. I like their growth. I like their growth a lot. Look at that growth. When we look at the quarterly, the growth continues. Balance sheet looks good. I believe they have zero debt with some cash. Zero debt here. They have some long-term debt. They have more cash than debt. Very good. And they produce how much? Free cash. So free cash, and they have a net positive cash position compared to debt. So this one here is suggested by somebody on a comment on a video. I looked at it. I'm like, wow, this is a neat little company. So I put it on the docket to cover, and I'm going to start watching this company because, technology has been really excited about semiconductor, which, I'm not going to spend a lot of time there. But within technology, other places have been neglected. Software companies. Like if you look at Adobe, neglected. Bill Holdings, neglected. Other stocks within technology, software companies, DocuSign, I think somewhat neglected over the last quarter because all the attention is focused on semiconductor. Well, that could be an opportunity. So that's Bill Holdings. And then BWXT. This one came up. I forgot how, where, when. Yeah. So this is a company that does nuclear components. Came up in the last live stream. I wanted to come here as well because I think I believe that nuclear has got a future because it's not really used a whole lot here in the United States. If we are going to see an increase in electricity demand, we just don't have enough coal burning power plants, natural gas burning power plants, but nuclear could be a very good solution. So I wanted to kind of come back to this one. Thank the person who brought it up on a previous live stream because that one now is on my watch list. And I'm not ready to jump into it right now, but I'm going to keep watching it because I think this is going to be a very positive play for the next 5 years, 10 years. Because I think I'm expecting that nuclear is going to continue to be more acceptable. People aren't going to be all freaked out, even though it didn't help to have the Oppenheimer movie last year where they had nuclear bombs going off. But overall, I think people realize that nuclear is quite safe. I know we've had a couple incidences over the last, call it 60 years, but really compared to the other alternatives, it's not as harmful. So in my opinion. All right, let me catch up on some comments here. LPX, TGLS, one of my best performers in my portfolio. Very cool. Soren, very good to see you, man. I think it's your first comment on the live stream. Appreciate you joining. Louisiana Pacific, is this a railroad? Louisiana Pacific provides building solutions, primarily new home construction. Yeah, home builders. Man, this one, so interesting that the housing scarcity really drove up home builder stocks. Very nice stock. Congratulations. Very good move. Pays a dividend. Been really rising. Market cap is 6.4 billion. Now, I think home building works until it doesn't. And I think it's going to keep working because you just can't create the number of houses that we need in the United States in 5 years, let alone overnight. So these guys are going to continue to have demand. And if they build in the right places, they're going to continue to have customers buy their houses. I think acquiring at the right price level is the key. And then keeping your eye on not necessarily housing this year, but kind of having a good eye on the forecast and the economic factors that are going to affect housing. So good one. Thanks for the suggestion. The other one you had was TGLS. Technoglass. Technoglass manufactures, supplies, and installs architectural glass, windows, associated aluminum, vinyl products for commercial residential construction. So this is construction based over the last year, up 35, year to date 24. Yeah, so construction, looks like it's been doing well. Interesting. Forward P is 14, 2.6 billion market cap, small dividend. Revenue has been growing. This is a small company, but it looks like it's a solid company. If you exclude the COVID year, this company is very well operated, consistent growth. So this is Technoglass construction. Nice chart. Good little company. Not exaggerated kind of return. It's been a good return. And this seems like a very well operated business, high level. Yeah, good idea. Neil, Airbnb gets a yes from Neil. 3.9 billions, lads. Billions. Industrial properties. Easier to buy, $35, guys. UAA near all-time low. Under Armour. This one here, I'm into Nike right now. And, Under Armour was potentially going to be that rival to Nike, but they faded. They faded poorly, badly. Let's take a look at their revenue. So the revenue doesn't look too bad, but they've kind of been around this. Now the revenue looks pretty decent. They've been growing, and the one company that did really well Friday was Decker's Outdoor, which does the Coca shoes, which are really comfortable. And they're kind of they don't compete against Nike. They don't have the volumes, but they did really well. Their stock was up 12 or 17% on Friday because they did their earnings. They're doing really well. So I think this potentially could be a really nice stock. If you buy it at the right time, it could be a nice stock to see it bounce up. But you have to see that they're going to be growing. The way these guys can get out their stock out of the mud is to start growing. It looks like the quarterly is not helping them. Quarterly, it's showing that you're actually seeing, revenue go down. And it might be that their product just isn't desired by their customers, right? Under Armour, they started with the apparel that goes under, let's say, your football pads or your running clothes and so forth. And then they got into shoes. Well, is the consumer now moved away from that? And they're like, no, we're buying other stuff. So that would be, I would first want to believe in the business, because this story basically says that not a lot of people believe in their business. This is not a relevant company anymore. Thanks for the question. Cool. You're going to watch, I think, one of the stocks. Paulo. Hey, hello from Portugal. Thanks for tuning in. Love to visit your country. And thanks for tuning in. Yeah. Hey, thanks for the comments, cinematographers. I appreciate you guys. I'm having a lot of fun on my side. Really appreciate you saying that. So there's a REIT or more residential. Okay. So if these guys do multifamily, invest in residential. So Armor Residential REIT invests in more residential mortgage-backed securities. The United States, its securities portfolio primarily consists of United States government-sponsored entities. So these guys are buying the debt. Okay. So this is more like, in my opinion, it's more of a financial services company. Look at this dividend. Beautiful. Almost $1 billion. Revenue is because I think they just receive the revenue from these loans. I don't quite understand their financials. I'd have to get my head around it, because how can you have negative revenues? Negative. I'd have to look at their website and kind of get my head around it. So this is where you're investing in mortgages, and if you believe in them, great, you're good. I would not be an investor. Here's why: is that I think that the real estate market has been hugely disrupted. COVID obviously took a lot of inventory away from the market. Prices have continued to go up. I'm an investor in residential real estate. That's my number one portfolio holding. Most of my net worth is in real estate. And okay, great. Thank you, market, for increasing the value of my assets. I sold a property at a huge gain in 2022 because I just thought prices were just through the roof, and I wanted to take advantage of it. I think that in a lot of places, what's being hidden is probably property owners, people that live in their homes, that are probably overextended, and they bought 2 years ago, just barely qualified, and there was a 2-income family potentially, or however many incomes it took to qualify. Somebody loses a job, they really get overextended. That all, like the subprime mortgage meltdown that happened in 2008, that just happened in a very high level or very concentrated way. A lot of people defaulted on mortgages, and it created just huge write-offs. I would be afraid of something, not to the extent of 2008, but something like that happening in this space. So I wouldn't really enter it, but that's just me. That's my investing point of view. And would it be a takeover target of Under Armour? Potentially. That's a very good thought, because if you think about, like, there are businesses out there that this is what they do, is they buy a brand that does have a lot of awareness. They have a lot of brand value and equity. And you could easily put Under Armour in, let's say, Targets or Walmarts, and it's a brand that people, hey, I know what Under Armour is. It's not Nike, but I don't have to pay, $200 for a pair of Nikes. I could pay $50 for a pair of Under Armours. I could totally see that. So good thought there. Virgin Galactic. So I do not believe in Virgin Galactic. First, I don't know that you can pay me enough money. Maybe you could, to get on one of these private aircraft that launches you into space, just the edge of space. You become weightless for a minute or forever, how long you do. But the design of Virgin is also kind of inferior to the design that the Bezos company has. That one truly is a rocket. You go up there, you kind of float around, you come back down, and I don't know how many hundreds of thousands he just spent to do that. I can't get my head around that. But some people, I guess, are going to want it. I just don't. This one's dead on arrival for me, and I think they've also had problems. Like, look at the stock; it's dead. Uh, I can't believe to begin with. I can't believe the amount of capital that got into this position to begin with to make this business kind of start. Like, oh man, is there really an addressable market of people that want to go up into space? Now, is there an addressable market to launch satellites into space? A huge addressable market. So do I believe in SpaceX? Yes. Let's take a look at Rocket Labs. Is it Rocket Lab? It's Rocket. Yeah, it's probably this one. It's Rocket Lab, a space company, launch services. Okay, so this is a little more like what I would believe in, which is, hey, we're not going to have less satellites. We're going to have more satellites in the future. So if you have communications, right, like high-speed broadband and so forth, and you have all kinds of stuff, more satellites are going to go into space. You can have artificial intelligence, more satellites going into space. So you have a market cap of $2 billion. They are a $280 million company. They are losing money. Analysts think that it's a 68% discount. Revenue going up. Very good. Very good. They are losing money. So when they launch, they do have some gross profit, and it looks like their administrative costs, R&D especially, understanding, but this will not, their R&D costs will not exist forever. At some point, they'll be like, okay, we got our design matured, ready. We can make small modifications going forward. So that cost, I think, is going to come down. And eventually they'll become more efficient, I would think. Can their balance sheet exist, or can their balance sheet have enough cash for them to exist? 248 billion. You see how this cash balance is coming down, right? That's because they're burning cash. How much debt? So they have some long-term investments. Current debt 17, long-term debt 163. So 176. Okay, they have some positive cash flow, negative cash. So, man, this one's discounted, it seems. Man, this one is interesting enough to kind of be interested, but the fundamentals are not quite right. What worries me is they're burning cash, and they probably have about a year and a half left before things are going to get really financially dicey. Are they going to get the work that's going to increase their volumes? I think so. This would be interesting. Now, compared to SpaceX, publicly traded yet? What's SpaceX? What's the symbol for SpaceX? Does anybody know? Okay, they're not publicly traded yet. SpaceX is really doing well. And I think if they go IPO, it's going to take a lot of the investment. All right, Neil, thanks for agreeing. SPCE. Okay, got it. It's private. Yeah, thanks. How did I discover HiMix? Let me catch up on. Yep, I'm gonna get back to that. So it's private. Thanks, Andrevaden. Thanks for tuning in, man. Appreciate it. Okay, cool. And then how did I get to HiMix? Similar to what we were doing earlier. So this is how I've made money on semiconductor. So semiconductor is doing great, right? So within technology, I think semiconductor. I'm still not getting it right. Give me a second here. I will get it right. Okay, so we're going to go down to technology. And I'm trying to answer the question of how did I find Hymix? And it's going to relate to what I did earlier in the live stream. So I like a sector. For example, I like software. And you see how software isn't doing that great. That's what I'm talking about. Like some spaces within technology are open for investment. But you got semiconductor at 68%, computer hardware at 73. All right, so when I go into semiconductor, I'm like, okay, well, I think NVIDIA is overpriced. I used to own TSM. I made great money on TSM. I tripled my money. I owned Broadcom up until late 2023, made a very good return on Broadcom. I found Broadcom because in early 2023, late 2022, I saw that NVIDIA was just through the roof. So I'm like, okay, I'm going to find a semiconductor company that values based on my principles, and then I'm going to invest. And I invested in Avgo. I did well. I was up, significantly. I sold. Thank you very much, stock market, because I thought at that point Broadcom was priced at a 25% premium, and I was good. Continuing on, I could probably find a company or two, and actually more recently started buying into Qualcomm and doing the same thing. Because if you look at Qualcomm, look at where it was and look where it's going. And I started buying into Qualcomm here, and I've done really well with Qualcomm. Hymix was an exercise of looking at semiconductor and finding where there was value. And that's how I found Hymix. So, answer to your question. Well, I hope you're right. I hope Hymix explodes and stock goes up. I'll be very happy about that. So today's live stream was awesome, guys. Thanks so much for everybody attending. I hope that you guys got something out of my approach as I look at a stock screener, looking at sectors and then industries, trying to find some stocks that are discounted, because every market will have discounted stocks, every single one. It just gets harder when the stock market's priced high. And I'm cool with the market being priced high because my stocks are going up in value. I'm not going to complain that my Robinhood stock is up so high. I'm not going to complain that my Coinbase stock, my Qualcomm stock is up so high. I'm not going to complain about that. I'm just going to realize that it's a little harder to find the next place to put some capital to work. So that's the moral of my live stream today. Thanks so much, everybody. I really appreciate everybody tuning in. Really appreciate all your support. Everybody, enjoy your weekend. Take care.